Assalamu alaikum, this is Professor Muhammad Hassan Khan, and today we are going to start chapter number 10 of the course Credit Risk Evaluation. And chapter 10 is the pricing credit derivatives instrument. In this chapter, we are going to cover these five topics, which are first of all, first topic is objective, second is introduction, third is pricing default swap, fourth is asset swap approach, fifth is pricing credit spread option. And the thing is that I try to make this chapter very much shorter and try to cover all those important topics which are very important related to the examination point of view and as for knowledge. So almost we are going to cover, we have 12 pages. So before wasting time, let's start with the objective. So objective of this chapter, the chapter name is pricing credit derivative instrument. So main objective, these are the three objectives: understand how to price different types of credit derivatives, learn basic method and formulas used in pricing. Third is understand the role of risk, probability of default, and rates in pricing. This is a little objective, which I think that which is not important. Let's see the introduction. The credit derivative are contracts that let investors or bank manage credit risk, the risk that a borrower may not pay back their debt. So this is the introduction of the course. Number third part is the pricing default swap. Pricing default swap is the most, you can say that the key topic and the hot topic for this chapter is topic number third, which is the price default swap. And we are going to talk in very detail about the price default swap. And this we have the formula. You can see that the protection lag and the premium lag, and I have tried to cover this whole chapter into this two formulas, that which is the protection lag and second the premium lag. So third one is the price default swap. What the price default swap is, it's known as the CDS. We have already discussed this CDS in I think chapter number 4 or chapter number 5. So doesn't matter, don't go back, just listen here and see what that is. A credit default swap is like insurance or on a loan or bond. If a borrower default, the seller of the CDS pay the buyer. So mean to say that a credit default swap is like what it's like. It's insurance on a loan. It's like insurance on loan or a bond. If a borrower defaults, you talk about the borrower. Who's the borrower? You know that borrower defaults, the seller of the CDS pay the buyer. Borrower mean like there are three people: A, B, C. A means like A is you, B is that you're buying from a loan or a bond from that B person, and C is that you can say that the seller, or you can say the protector. So if you buy A, buy from the B, a bond. So if the B person default, mean to say if he is not going to pay the money of the A, so the C is the person who take the guarantee of that B. So the thing is that the credit swap default is like insurance on a loan. It's insurance on a loan or a bond. Mean to say A buy a loan from a B. So it's like you can say that the insurance on a B. B is like you can take a bond or loan from that. So if the borrower means B default, the seller, which is C, of the CDS pay the buyer. Okay. So the formula is that the protection lag PL, premium lag, which is PM. So I just try to explain protection lag and premium lag in this. You can say that try to explain this whole thing: protection lag, premium lag, and the formula. You can say that if in the formula in protection lag we have the notation into 1 minus recovery rate into D PD discount factor. So just over here look the formula, and I have explained this formula in upcoming slide, which is slide number this is slide number 2. In upcoming slide number 3, I have tried to explain each and everything, every part of the formula. So over here just only see the formula, that is the protection lag equals to notation multiply by 1 minus recovery rate into PD and multiply by discount factor. This is the formula for the protection lag. Secondly, we have second part, you can say that the premium lag. So the premium lag equals to notation into 1 multiplied by M into CDS spread into discount factor. Okay. into discount factor. Yeah. So let's see part number 4 of the topic, which is asset swap approach. What is this? The asset swap approach is the way to price credit risk by comparing a risky bond to a risk-free bond of the same type. You can say that what is this asset swap approach? Is like, you can say that is a comparison, comparing a risky bond to a risk-free bond. It's known as the asset swap approach. Simply, you can, if you want to understand this, understand what is this. It's a comparison of a risky bond to a risk-free bond. Simple is that. Now talking about what is credit spread. Credit spread, we have to talk about the credit spread. It's I tried to explain credit spread before this topic number 5. So in topic number 5, we have the pricing credit spread option. So before understand this pricing credit spread option, just understand what is credit spread. So I tried to put this little part over here. What is a credit spread? Credit spread is a difference in interest rates between a risky bond and a safe bond. What simply understand? It's difference in the interest rate. Interest rate, like the interest rate for the risky bond is different, and the interest rate for the safe bond is different. Let's see the example. A safe bond, a safe company pay low interest on its bond. Okay, as compared to the high risky. A risky company must pay higher interest to the interest to attract investors. Understand this? Example: a safe company pay low interest on its bond as compared to the, if we talk about this, a risky company must pay a higher interest to attract investor. Why? Because, for example, if a company is safe, so it gives the low interest to the investor, to the people who buy the shares, or you can say that the bond of that low risk company, as compared to the a high risk company pay a risky company pay high interest, because there's a chance that the company might be default or something like that. So that to attract the more investor, that company is going to pay the high interest rate. Okay, so the difference between their the interest rate is called the credit spread. So what the credit spread is? The credit spread is the difference in the interest rate between the high risk and the safe bond. It's like a difference, like you can say that you can make a difference if you want to make a difference. So that difference between the high risk company and the low risk company, safe company, is known as the credit spread. So let's understand what the pricing credit spread option is. Pricing credit spread option means finding out how much the option is worth today based on how likely the credit spread difference between risky and safe bond rates will go above or down a certain level in the future. Mean to say, we have already understand the credit spread. What the credit spread is, it's like, you can say that the difference between the risky and a safe bond. Same as it is, it's explaining this thing. The main part of this is like pricing credit spread option means difference between the risky and the safe bond. Risky bond and the safe bond, difference between. Mean to say, how much will go above or below down, how much the rate go up or how much the rate go down in the future. Okay, that's known as the pricing credit spread option is. So this is you can say that this is a reference for the, you can say, for topic number 3, pricing default swap. I try to explain this in a class. Let's understand this. Make it larger. So 1 BPS, this is a reference for understanding, for solving the numerical. For example, if you have 1 BPS, mean you have to divide 1 BPS with 0.01. Let's see this how. Calculator. Open the calculator over here. 1 BPS. If you want to convert 1 BPS into the percentage, so simply put the calculator here. 1 divided by 100, you got 0.01. Okay, this is in the percentage. 1 BPS in percentage is 0.01. Again, if you want to convert this percentage into decimal, so you have to again divide it by this value 0.011% or 1 bps, which is 0.01%, then you have to divide this again with 100. So you got 0.001. You can see over here 0.0001, 30 and 1. Simply, if you want to get the answer directly, if you got 1 bps, so what you have to do, if you want this in decimal, simply 1 divided by 1 0 100 and again 0. You mean to say 1 0 of percentage and 2 0 of percentage and 2 0 of decimal. Simply you got directly answer of 0.001 decimal of 1 bps. In decimal you got the answer. This is the shortcut, like jumping from here to directly here. Okay, simply divide with what? Again I tell you, let's take example number 150 bps. 150 bps divided by how much? 100. If we do this, divide by 150 divided by 100, and we come into the percentage. No, we don't want to come here. We directly put 20 more here of decimal. Simply get 0.015 in decimal. This is a simple, you can say that a conversion rate. I have tried to explain you the reference to understand, because this, if you got this in question, so mean you have to convert this into decimal. So without if you just want to if you want to save your time, you just convert this directly from here to here. Instead of you are shifting 1 divided by 100, you got 0.01, then you again divide by 100, and you just coming over here. Okay, so instead of doing this, you only directly divide with, you can say, I give you another third example. Let's check with 200 bps divided by 100. If you do this, 200 divided by 100, you got 2%. We don't want to come in the percentage, we just directly want to come in the decimal. So 20 again more, mean to say 10,000. You got answered 0.02 exactly. Yes, this is, as you can say, that a simple learning point. So this table is going to help you under solving numerical of CDS over here, price default swap, CDS. Okay, let's see what is the protection lag and the premium lag. I've told you that I will explain this over here in slide number 3. Protection lag, PL. We can say that protection lag is the form. You can say that money paid after default. This is the money which is paid after the default. If the company become default, so this is a protection lag, money paid by after default. So the formula for that is protection lag equals to notation into 1 minus recovery rate into PD into discount factor. I will also explain all these points over here, that you can say that you can also see I have divided this in parts: A, B, C, D, E, F, G. Almost we have F part, sorry, not G, we have almost F part over here. So this is the formula, protection lag. The main thing is that the formula, if you learn the formula, you can easily solve in the paper. Notation into 1 protection lag, notation into 1 minus recovery rate into PD, probability default into discount factor. Okay, next we're going to have premium lag, which is the regular fee paid for protection. What is this? Regular fee paid for protection. What is this? What the formula is? Premium lag equals to notation, again multiply by M. What M is here? M is the maturity, into CDS spread. CDS spread, we're going to explain, see this in upcoming slide, and multiplying by discount factor. This is the formula for premium lag. So let's see what the notation is. The notation amount is the total face value or principal amount on which the financial contract, like a credit, derivatives, loan or swap, is based. You can say that the actual amount of that sum of any asset is known as the notation amount, simple principal amount. Okay, next we're going to have what is B, CDS spread. You can see that CDS spread, we have tried to explain what CDS spread is. This is the annual fee or premium pay, premium the buyer pay. The buyer pay who? Buyer pay the seller of the CDS. Okay, what is CDS spread? CDS spread is the premium amount or the fee. Simple, understand that. Fee pay pays the seller. Buyers pay the seller. Okay. Third, C, you can see maturity. Where is the maturity? M is the maturity. We have understand notation. We understand the CDS spread. Let's see what the M is. M is the maturity. The length of the CDS contract, how long the protection lasts, that how many years maturity, for 5 years, for 10 years, for 15 years, for 2 years, maybe depend on the contract, that how much that contract is going to last. Okay, protection, like how long it will go. Simple. M is known as maturity. Now talking about the recovery rate. I'm not these like split. It's a recovery rate. So where the recovery rate is? Over here. Notation into 1 minus recovery rate. What the recovery rate shows to us? If the borrower default, it is expected that only 40% of the money will be recovered. Like for example, if the borrower give you 40% amount of the money of the principal value, so after a whole 60% remain, if you talk about in the 100% form, 40% is recovered. So the remaining 60% loss given default is what the CDS seller might have to pay. CDS is going to pay remaining 60% out of 100%. This is called calculating the protection. Like simply this, I try to explain this recovery rate by this also. Simply, the definition of the recovery rate is if the borrower default, it expected that only 40% of the money will be recovered. That this is the definition of the recovery rate. Like what money you have recovered from that the borrower, you can just the money to whom you give. Okay. Now talking about the commutative probability of the default, which is PD. PD, where is PD? We over here. PD. What is that? The estimated chance the borrower will default during the contract life. Commutative probability means how much chance, the estimated chance the borrower will default during the contract life. What chance? The borrower is going to default during his contract, like 10%, 5%, 20%. How much chance that the borrower going to default? Okay, probability means PD. Now we're going to have the discount factor. Where is the discount factor? Discount factor is also here. In both numerical, we have the discount factor. So what the discount factor is? Used to calculate the present value of the future amount of money. If you don't understand, doesn't matter. Let's see with the help of example. Before that, you can have to see this. It reflects the idea that money today is worth more than the same amount in the future due to interest, inflation, or investment opportunity. Let's understand with the help of example. If you expect to receive $1,000 next year, but the discount factor is 0.5, the percent value of that money today is 1,000 multiplied by 0.95 equals to 950. Mean to say that the future money value is going to be devalued due to interest rate, inflation rate, or something, any kind of investment opportunity. So discounted factor is going to be, you can say that the inflation rate, that the money value today is going to be higher as compared to, if we talk about the today's money, like 1,000 rupees value will be going to devaluate in upcoming 10 years, 15 years. You can say that the due to the inflation rate. That so discounted factor is what the worth of the money in today's as compared to the future amount. Okay, this is a little summary of all we have explained: notation, amount, CDS spread, maturity, recovery rate, probability default, discount factor. So let's see notation, amount, value of the insured asset, CDS spread, yearly fee rate, maturity, contract length, recovery rate, expected recovery, recovery after default, PD, probability default, likelihood of default, discount factor, adjust for time value of money. So bring future cash into the present. Okay, simple as that. So this is the main thing. The main part of the chapter is the numerical, which is the price default swap. We have already done this in the class, so I tried to explain you over here. So let's see. Let's go and see the numerical. Let's question number 1. are given the following details to calculate the both leg of the CDS contract. Both leg means the premium leg and the protection leg. Protection leg and the premium leg. You can see the premium leg is over here, part 2. So let's see this. Yeah, over here this is a numerical. We have parts of that. The value which we have given the numerical notational amount, which is, you can say, the principal value or the actual value of that, which is the 10 million, or you can say that the 1 CR, unit 10, 100, 1000, 10,000, lakh, 10 lakh, or 1 CR or 10 million. Notation amount is 10 million or 1 CR. Second is CDS spread, which is 150 BPS point. I have already explained the table. If you have this, so you can directly convert into the, can also open the calculator. 150 directly divide by 1, 2, 3, 4. You got 0.015 in decimal. 150 BPS. First you convert it over here. I show you 150 divided by 100. You got 1.5%. Then again dividing this by 100, you're going to get in decimal 0.015. Okay, maturity is 5 year, recovery rate is 40%. Also convert this 40 simply divided by 100, you got 0.4. You will see in the question and the solution. Commutative probability, which is PD, 10%. Let's see, 10 divided by 100, you got 0.1. I forgot to convert this rate in this recovery rate into the decimal. Now talking about discount factor, here I just give you the, in class we have two discount factor. First of all, we're going to solve with 0.95. Secondly, we are going to solve with 0.08 by having the same value. Okay, let's see using the protection leg. We have already discussed the formula. Notation into 1 minus recovery rate into PD into discount factor. Notation value is 10 million. 1 minus recovery rate, which is I converted over here 0.4. 40 divided by 100 equals 0.4. Okay, multiply by PD. Probability default, which probability default is, you can see over here, probability default PD, yeah, over here 0.1 or 0.10, same. Now discount factor, over here we put the discount factor 0.95. First of all, we're going to put this 0.95. Then the answer after solving this, we're going to get 570. And if you put 888 over here, having the same value, just we're going to put 0.88 instead of 0.95. Then we're going to have 528,000, 5,28,000. Okay, we have solved part number 1. Let's move toward the part number 2, premium lag. First of all, we have solved the protection lag. Secondly, we have to solve the premium lag. What the premium lag is? Premium lag equals to notation into M into CDS spread into discount factor. Notation value is 10 million into maturity is 5 year. CDS spread is, you can see over here, CDS spread is where we have converted this value 0.015. Simply put into, first of all, we are going to put discount factor as 0.95. After solving this, we got 712,500. And if you put 0.88, we're going to got this answer. Okay, this is how we're going to solve a price default swap by using the both legs of CDS contracts. So this is very easy numerical. This is question number 1. Same as it is, you're going to have this question, values, putting those values in the numerical formula, getting the answer, same, put in the protection premium lag, solving, got this answer. You can also solve this by your own self. This is the numerical number 2 and this is the numerical number 3. This is the answer of that. So you can solve this. I have explained this question number 1 in detail. You have to solve this question number 2, checking the answer. This is numerical number 3, checking the answer. So Next topic is asset swap approach, which is topic number 4. Asset swap approach. Asset swap approach. Let's see what the asset swap approach is. Numerical for the asset swap approach is. Formula is asset swap spread equals to bond YTM yield maturity minus benchmark yield. Okay. This is a you can say that the giving things to us, that is a bond price. This formula, that understand a formula. Asset swap spread equals to bond yield maturity minus benchmark yield. Okay, so the bond price equals to 95, coupon is 6%, YTM yield maturity is 7.5, benchmark is, you can see over here, 3.5%. Simply what we're going to do, we only have to subtract bond yield maturity with benchmark yield. Simply over here, bond yield maturity is, you can see over here, YTM is 7.5. Simply benchmark is 3.5. Simply you have to subtract these two values. Simply got down. So these two are just given the question for making you confused. Okay, don't confuse with these two values. Same over here, part 2. Simply bond 9%, or you can say that treasury bond. Simply with the help of formula, what formula is bond or benchmark yield. This is the treasury bond, or you can say that bond benchmark yield. Simply a bond YTM 9 minus 4.5, you got 4.5. Example number 3, simply benchmark, you have to minus YTM with the benchmark, which is 6.8 minus simple 2.5, you got answer 4.3. This is the, you can see, the very easiest numerical of this topic, asset swap approach. Third is third numerical, this is the 5th part, pricing credit spread option. What that is, pricing credit spread option. This is simply one numerical. What's that? You can see the formula. Payoff equals to spread at maturity minus strike spread into notation. Payoff equals to spread at maturity minus strike spread into notation. What's that? These are the few things which are giving to us. Current spread initial equals to 180 BPS. Second, strike spread, which is 150. Third is spread at maturity, which is 220 BPS. Notation amount, which is you can say 200,000, 1 lakh, 10 lakh, 20 lakh. Okay, step for some simple solution. How to solve this? Solution: spread at maturity minus strike spread. Spread at maturity is 2220. Okay, simply we have put it over here. Strike spread is 150. 220 minus 150, we got 70 BPS. After converting BPS into decimal, let's check. 70 divided by 234, simply we got 0.007. okay, and multiplying with simply notation value, which is 1 2 3 4 5 6, you got answer 14,000. This is the answer of the pricing spread option. So this is all from this chapter. I hope I try to explain this chapter in very short and you can say that try to make this chapter very short and try to make this chapter very easy for you. Thank you very much. See you in the next video. Till then, Allah Hafiz. Take care. Bye bye.